So I have 4 different partnership models. Well, really 5. This is the first one we're looking at here is 2 built in 1. And this is where you can play with the split between the sponsor and the limited partners and the profit interest and see how it affects your cash flows, your returns, and also your limited partners' cash flow and returns. So just to be clear, I always refer to the sponsor as the GP, mostly because I didn't feel like spelling sponsor every time. I just wanted to copy and paste GP. So GP is you if you're raising the equity. LP are your limited partners that aren't involved in the day-to-day operations. If you're doing joint venture structures, these would work for that as well. You just need to maybe relabel what you're calling the GP and the LP. That's totally fine and up to you. So the first model here is just a straight profit interest, or pari passu. Pari passu means everybody's getting an equal portion in terms of cash flow to what they had originally invested in the deal. So if you, the GP, put in 20% and you were running a pari passu model with your limited partners, you would just hold the profit interest steady with the contributions. And you can see that the IRRs and the equity multiples for both the GP and the LP are the same as the project. A lot of sponsors or general partners will put in 5%, let's say, and they'll instantly have a 20% profit split on all the cash flows. The IRR and the equity multiple will be swayed greatly for this general partner, as they're getting a significant percentage of the cash flow as compared to what they had put into the deal. And the LP on the other side, their IRR and equity multiple will be less than what the project IRR and equity multiple is. If we go down a little further, if you're charging other fees, those will flow into the partnership models here. I read a great book by Gene Tobridge who talks about syndication and returns, and he doesn't think any of the acquisition or disposition or asset management fees should be included in the returns. And he really breaks it up into, when you're syndicating equity, there's 2 parts. There's you doing your job, putting the deal together, and those fees are necessary for that, right? You're taking on a lot of ability and you're using a lot of skill to make a deal happen. But those fees should not be included as cash flows of the deal. They shouldn't be included into the calculation when you're solving for what returns the deals are providing. That should be held separate. So I just ran with that. I have fees separate here. In the model we're currently running, we don't have any. But if we did, for example, go back to our summary tab and put in a 2% residual fee, and a 2% acquisition fee, you can come back and you can see that now there's a total that's calculating the fees plus the cash flows from the deal. We still don't have an asset management fee in there, but I do have a row dedicated to asset management where if you charged a percentage of EGI typically, that would flow into the partnership model as well. One more thing I want to point out is that if you're raising money for a deal and you're putting in 0% and you're taking a profit interest, which is common, the IRR and equity multiple will just read at 100%. It would normally be an error because you're not putting money in, so technically you can't have an internal rate of return or an equity multiple. So just keep that in mind, and at that point you just really need to focus on the cash flow coming in from the deal and some of the other fees. The next partnership model option you can do is a preferred return plus profit split. So this is almost identical to what we were just looking at. However, you need to specify a preferred return that you'd be willing to pay to your limited partners. In this case, it's 6%. Then in anything in excess of 6%, there'd be a promote. The distributions would be pari passu until that 6% promote structure is reached, and then it would convert to a 20%, 80% split. So you can see again, the IRR and the equity multiple are heavily swayed to the general partner. If you increase this preferred return, it'd be more beneficial for the limited partner as they're getting paid back more before the promote structure comes into play. If you want to see how the cash flows are calculated, I break those down here below the summary of distributions. It's these dark rows. These are the actual distributions. So there's a distribution row, then there's a promote row. So the deal doesn't get into the promote until year 4. It's also important to point out, and I have a note here, unpaid balances do accrue. So in year 1, for example, you can see for the limited partner, their initial equity investment in the deal is $1,025,050. The cash flow generated from the project wasn't sufficient to pay the full 6% promote. It was a little shy of that. So the following year, that unpaid portion of promote is then tacked onto the starting balance. And then once you have a good understanding, you can see obviously the promote gets pretty significant during the reversion year. But you can hide these cash flows, and you'll just have a clean model where you can plug and play with the different contribution and in the promote splits. All right, and then we get into the IRR waterfall. I won't bore you with the details on how long it took me to build this, but one thing I want to make very clear, not all IRR waterfalls are created equal. I referenced a lot that I found on the internet that other people were building, and everybody has their own spin on how this should be done. I will say with my IRR waterfall, I try to keep it as simple as possible. You can see here that we have a contribution percentage that the GP and LP would put in like we do with any of the other partnership structures. And then we get into the hurdles. So this model allows for 3 different hurdles, from a 0% to a 10% IRR, from a 10% to a 15% IRR, and then 15% and up. So from 0 to 10%, the profit interest would be the same as the contributions. The cash flows would be distributed pari passu. And then from 10 to 15, it'd be a 20-80 split between the GP and the LP, and then 15 and up would be a 50-50 split. Now, how my IRR waterfall works is it's, for example, in hurdle 2, it's a legit 20% of the cash flow. I've seen other models where it'll run it in a way that the general partner would get their 5% plus 20% times the LP's 95%. So it'd be like a net 24% of the cash flows in that hurdle. And then obviously the LP, it would be 76%. But I'm just doing it straight profit interest percentage to keep it as simple as possible, because this stuff's hard to understand and interpret. I haven't mentioned it yet. I try to keep things color coordinated so it's easy to follow along. And then you can also see a detail of the partnership cash flow summarized below. See, this is how my mind works. A lot of stuff I was looking at was confusing and it didn't make a lot of sense. But basically how I detail these cash flows, the actual cash flows that are flowing into the partnership summaries here are the dark rows. So the first 3 columns are simply just dedicated to the project, to that tan color. So it's the hurdle 1 project cash flows, the hurdle 2 project cash flows, and the hurdle 3 project cash flows. As you work down through the years, so there's going to be 5 rows dedicated to each year. There's a starting balance, a required return, the actual distribution, the cash flow left over, and then the ending account balance. As you work down through the years, you also need to work to the right to see what's going on with the hurdles. Typically, you're only going to get beyond hurdle 1 if there's a capital event, such as a refinance or a sale of the property. So you can see in year 1, the cash flow is just distributed pari passu. I have the allocation percentages as we stipulated above. You can see that the GP would get $2,458 in the LP, which is a typo, would receive $46,697. Just like in our preferred return plus profit interest model, account balances will accrue. So you can see here that the cash flow early on isn't enough to fulfill the 10% IRR required return. So whatever the distribution is short on will get tacked on to the end account balance. So you can see here for the project cash flows, they'll jump from 1.14 million to 1.19 million, call it roughly. And as we work our way down, once we get into year 7, we'll finally get into that second hurdle where the cash flows will be split 20% to the GP and 80% to the LP. Because we set our third hurdle at a minimum of 15%, the project IRR is 12%, we won't accomplish that third hurdle. But what we can do then is go to our summary and see if we have changed the pricing, decrease the pricing, see what it takes to get into that next hurdle. So now we're achieving a 15.29% IRR on the project. So we should now be getting into that third hurdle. Let's see if it works. All right, it does. And you can see that it's a 50-50 split. So the distribution is even between the GP and the LP. Like any of my other partnership models, you're able to toggle the hold period to see how it would affect the returns. I bet if we do it shorter term, that will boost the IRR, which will boost the hurdle. So now the IRR goes up to 16.08%. You can see now we get in the residuals year 5 in the profit split in hurdle 3. would be $44,342 between the GP and the LP. And then the final partnership model is just one that I've seen that's not used very commonly, but I thought it's very interesting. Again, you'll put in the contribution amount for both the GP and the LP. But this one has a kicker, a sale kicker that's based on the project equity multiple. So you can set equity multiple thresholds and then set a percentage of the residual sales price that you'd get as the GP if you accomplish whatever project equity multiple you stipulate to the left. So if the project achieves a 3%, you would get a 10% kicker on top of whatever your contribution split is on the back end of the deal. So 10% of this residual sales price. So a compensation structure like this is super backloaded. You won't really see any benefit while you're operating the property, but if you were aggressive enough and your investors checked off on a payment structure like this, you could be compensated significantly well when you go sell the deal one day. Partnership structures are really limitless. As long as you can think of something that's creative and an attorney can put it on paper in the operating agreement, anything's possible as long as your investors are checking off on it. So this is probably the request I get most frequently from my consulting business, is to come up with a unique partnership structure that then the ownership group can accurately model and present to investors. So if these partnership structures don't necessarily fit in your box that you've done in the past, or you want to try something slightly different, reach out to me. I love learning new promote structures and building these things, and I'll be able to fine tune it to whatever you're looking for.